In the 206 Block Talks, we speak with Hart Lambur, co-founder of Across and UMA, who talks about the big interoperability unlock. I'm your host, Mauricio Magaldi, and this is Blockdrops, your weekly digest on blockchain for business. These news are not a form of endorsement, sponsorship, or encouragement for consumption, and are meant for educational purposes only. All right, everybody, I'm here with Hart Lambur, who's going to tell us who he is and what he does with blockchain. Hart, welcome to Block Talks.
Maurizio, thanks for having me. Great to be here. I am a builder in the blockchain space since 2018. I've actually worked on two protocols that I still work on. One is UMA, which is best known as the decentralized Oracle source for polymarket prediction markets. And the other is Across, which is a cross-chain intent-based bridging protocol, which lets you move assets really quickly between blockchains, focusing on the EVM, but lets you move assets really quickly in like 2 seconds between blockchains using this kind of novel architecture. And there's a long story about how they came back and forth, like how Across evolved out of UMA, but that's what I've been doing in this space for a long time. Yeah.
How did you come across first through crypto? What is your earlier career? How did that lead you to crypto, and what triggered the interest of like, oh, this sounds like an industry I would be great at doing, and I just want to take part of that and build a new internet? What was that? Was that the feeling? Was that the curiosity? What was the thing that really pulled you in?
For the crypto space, maybe like you, Maurizio, I'm on the older side. I've been around for a bit, and I studied computer science back in the day. I then worked in traditional finance. I worked at Goldman Sachs for 8 years through the financial crisis, where I was a bond trader. I traded U.S. Treasuries, and learned a lot. And it's also, with all the tariff stuff, that world's really interesting again. But learned a lot about interest rates, not something I was changing. Learned a lot about financial markets, learned a lot about incentive structures, I think. Uh, I then started a fintech business, which I did for 4 years before getting into crypto. But to go back to your question, at Goldman, I was buddies with Fred Ursum, who went on to found Coinbase. So it's like that is my crypto kind of story. So I met the guy that founded one of the bigger companies in crypto, and he pilled me on Bitcoin quite a while ago.
So you were orange pilled early on, and I mean, what's the stint on fintech? How did that happen between getting out of Goldman and getting onto a fintech, and what was that about?
Yeah, no one's asked about that in a while. So thanks. Yeah, I mean, I I didn't want to work in traditional finance like at a big bank forever. I was always a tech guy at heart. Um, and in this is like 2013 era, um, there was, if you go back to that moment in time, there was just a lot of like, hey, software needs to reinvent financial services in a way that makes it easier for people to do financial things. And so you had like the neobanks, like Revolut and that kind of stuff being started around that time frame. You had Robinhood, the trading app that's big in the States, being started around that time that we actually like worked closely with on this fintech business. And we were trying to build a business to help people make better investment decisions, kind of using big data, like early bits of big data, and a little bit of like a social sharing component. And it was pretty cool. But if I'm being totally honest, the business went sort of sideways. So I spent 4 years doing that. I got it acquired by an asset manager in New York. It was a great learning experience, but yeah, it wasn't. It didn't click. And yeah, coming out of that, I kind of thought I'd never start something again because I was traumatized. But for me, coming out of that kind of 2017 into 2018, the very beginning of 2018 era, Ethereum was around, smart contract platforms were around, but nobody at that time was really thinking about how to do finance on blockchains. And DeFi, decentralized finance, was not a term yet. Um, and I just felt like kind of my background in um, fintech, but also finance, technology, economics, incentive structures. and just financial market structure. I honestly felt like drawn into trying to figure out what decentralized finance would look like. And that was really fun and great timing to kind of do that starting around 2018.
Yeah, that's interesting. I have a friend, Andy Martin. He usually says that being early is as bad as being wrong. And sometimes you're in such a like the edge of something innovative. You're solving a very niche problem that people have yet to realize they have. And then time goes on, and just run out of gas, or something else happens, and it just like as if you were never there. And now we're talking about agentic finance on chain. Like it's just some weird concoction that blends all these novel things, which are kind of novel-ish, but been around soft trading finance. How many times I heard that over the years, but yeah, interesting. Just gonna pick on your. I thought I would never start something again. Usually, people start something because they see a problem that has not been yet addressed, and they get really annoyed that no one is solving for that, and they go after doing whatever they have to do to fix that. Um, what was that like when you broke into crypto? I'm like, okay, DeFi seems like something. What was broken that you said I have to dedicate my life to this? Because it comes, being an entrepreneur comes at a personal cost to a certain extent. So what was the thing that really disproved your I'm not going to start something new again?
My early thesis around why DeFi mattered, and remember, crypto is like really small back then. The number of like users of Ethereum literally is probably like 50 people that actually used it to do things other than just speculate. Um, and the ICO bubble, this 2017 ICO bubble had popped here. But if you look at financial services, so ignore crypto and look at financial services, and you can make two observations. One, financial services were shockingly localized or regional. So the financial services that were available in the US were not the ones that were available in Brazil or in the UK or in Asia. Um, it just didn't happen. And you think about this and you're like, wait, it's the era of the internet. Internet businesses should be globally accessible. I should be able to kind of do anything from anywhere in the world, which you see with social media. But we're like, wait, finance, I can't do that. And you're like, why is that? And in my opinion, the answer is financial services, traditional financial services are all rooted in the legal infrastructure of your home country, right? You like have laws and regulations that keep your money safe based off the rules of the US for like Robinhood, and based off of the UK for like Revolut or, whatever. And all these different businesses, they can't offer their services to other parts of the world because the enforcement infrastructure is localized to their home jurisdiction. And that's why big global financial services companies have to start completely different subsidiaries that like have different regulators and all this different stuff to offer their products elsewhere. And so I'm like, okay, well, like that seems silly in this age of global internet everything. What would be required to provide a financial service globally? And to me, the requirement is, well, I have a different incentive, a different enforcement mechanism. I have a different way of enforcing the rules of this financial contract. And da 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 da. Okay, wait, Ethereum could actually be that. I could design incentive structures that use crypto and smart contracts to enforce the rules of a financial service globally. So that's kind of part one about why I thought this was so damn cool. And I still think, saying it back to you, I still think it's so damn cool, right? Part two is innovation. Innovation in financial services is incredibly expensive and difficult traditionally because, like, you have to go through all the regulation and all the hurdles, right? If I wanted to invent a new financial product or service, I have to spend like I don't know $10 million and a bunch of lawyers, or $100 million and a bunch of lawyers to get it approved in like the traditional world, or like at Goldman Sachs or something like that. And I was like, okay, well, it would also be cool if you could lower the barrier to innovating new financial services so that a 14-year-old kid in their basement could, in theory, launch this. There's downsides to this too, because they could launch bad things, like, or like, call it scams that could happen. But if you take the optimistic view, lowering the barrier to innovation seems like a strictly good thing for the world. And so those were my two theses as to why decentralized finance was like super interesting. It's like, okay, let's make it global and let's make it easier to innovate.
I love that. And how did you go from that problem statement into building the businesses? Because you cited two things, Across and Uma, and I don't think they came to the world together. So I would want to explore more of the story. But starting from that problem statement, how did you decide what to move next? Because I'm a product person. I'm looking into the why and the how, and you laid out the why, but how you went from that problem space into, okay, this is the very first thing I'm going to do, and this is how I'm going to approach it.
Yeah, you got to remember that kind of back in that era, a lot of this was very researchy. It was very much like these were like um, theories and ideas more than products. And that's not necessarily a good thing, by the way. Like, I'm not saying that that's like a good thing. It's just sort of a reflection of where that space was at the time. Um, and I actually enjoyed that. I was like, okay, I'm okay with like kind of trying to figure out what these if these research ideas work. That was kind of fun. Um, and so to just answer your question, the UMA idea originally was like, okay, we could write a smart contract, like Maurizio, you and I could write a smart contract that says, okay, if Bitcoin goes above 125 grand by the end of the month, I pay you X and you pay me Y, right? We could do that. That was pretty easy to do on Ethereum. The sticking point was like, wait, how do I get the data that says whether Bitcoin is above 125 grand or below it? And so UMA evolved into this Oracle project of how do we get arbitrary long tail but verifiable data onto a blockchain. And it's actually based off of a lot of work that Vitalik wrote in like 2014 because he's, crazy genius and foresees the future. He wrote this idea called Shilling Coin in 2014, and we combined that with other work from Augur, which was like a early prediction market, to come up with this crypto economic system. So that's kind of like how we got there. Um, and then to further your thinking here, on Across, we started seeing all these roll-ups, these L2 roll-ups from Ethereum come onto the scene, so Arbitrum and Optimism. Um, and we realized that there was going to be this interoperability problem between blockchains. And there were these 7-day bridges. And we're like, okay, that doesn't really work to take 7 days to move assets between chains. So we actually figured out a pretty innovative way using a lot of our financial engineering to come up with this faster mechanism for moving assets between chains that used the UMA Oracle system to validate whether these fills had happened, whether basically these orders had happened. And we can go a lot more into like the across intent-based architecture and why I really do think it's like the future of how we like unify Ethereum. Um, but that's how we got there. So that's the story arc.
It's funny that in crypto, I don't think this is, I mean, you're a former financial services guy as well. We haven't seen that pace of innovation by gathering pieces from different sources, like a writing from Vitalik, inspiration from another similar project, but it's doing something different, and pull those pieces together and build something in the speed that we are able to build now, because financial services is an open source. They refuse to work in an open source world, whereas crypto, by its own foundational ethics, is very open source. Like, if you're not open source, people will, like, well, sure, do your thing. They're not going to engage, right? And that's an important distinction between the TradFi and DeFi world, or centralized and decentralized world. For that, so I don't think we've seen any of that. You have M&As, and you have acqui-hires, and you have other forms of capturing IP to a certain extent, but not as open and certainly not as fast as crypto can move. And that's kind of, but funny aside, I met Jeremy Gardner from Augur in 2017 when I worked at IBM. It was very surreal because I knew about Augur, but we were doing enterprise blockchain at IBM, and all of a sudden I'm on a meeting with a guy who's absolutely the opposite of IBM, and it was a crazy, crazy conversation. It was really interesting, and now I think he's out of crypto. He's just like an investor in many different industries, but he made a number in Augur, and it was very, very foundational to that moment, especially because it was Bitcoin based. But well, that aside, so you're running UMA as a protocol, and you're running across as a protocol. You just you just manifested intents as the future of interoperability. Interoperability, in my opinion, is one of the biggest hurdles in terms of infrastructure today across the entire crypto, because multiple chains will have multiple different offerings. They'll have different capabilities. They'll speak to different audiences, and they'll cater to different flavors and solve different problems in different ways. But ultimately, the users could not care less about what the infrastructure is. They just want their problem solved. And it's really hard in the current interoperability scenario to solve a problem that is very complex with multiple pieces of infrastructure, because they just don't interoperate. And then for a builder to tap into a multitude of resources across multiple blockchains with different offerings, this is virtually impossible to do unless you're the one building the bridges and actively moving assets around, which is another deterrent for people who want a simplified, easy to use user experience. So I want to double click on, why do you think intents first, for the audience, explain what intents are, and then why do you think that they are so um, powerful to extend interoperability in the blockchain space?
Let's actually start with like the problem statement and then like how we got there, right? So the problem statement is, let's say there's two blockchains, A and B, Arbitrum and Base, we'll call it. And I want to use them in such a way that it feels like I'm using one network. I want this to feel like one unified, I'll call it a unified Ethereum, but you could introduce like Solana and other things too. I want it to feel like one piece of infrastructure. And so to me, um, one of the core requirements there is speed. It has to be fast. Like I can't wait 5 minutes or 20 minutes. Certainly can't wait 7 days to use this other chain. And to me, the core requirement is everything is 2 seconds or less is how fast it has to be. And I'm kind of making that number up, but it's also backed up by like Web2 research. Like Google's like, hey, if a website loads in more than 2 seconds, people just like close the tab and move on. There's sort of this like psychological barrier to 2 seconds being this thing that you have to hit. Okay, so let's say that's the problem statement. I need to move money to another blockchain and do something. We'll ignore the do something part for now. Let's just start with the first step of move money. I need to move some money from A to B in 2 seconds. Okay, great. Constraint. Well, turns out that sending a message between A to B, if I do it using the native bridge, it takes 7 days. And if I want to use some other trusted bridge that does something else, I would still have to wait for finality on, at least a sense of finality on chain A before I could send a message to chain B. I can't, because if my message was like, hey, go send this money, got a bunch of money, and that message gets reorged on chain A, well, I just lost a bunch of money. So I can't do that. So sending a message is constrained by finality on the origin chain. And so it takes time. You can kind of shortcut it and make some assumptions, but it's still going to take you at least a minute to send stuff between these two chains. And that doesn't hit our 2 second goal. So we're like, okay, shit, what do we do? Well, what if we introduce a third party, and we call them a relayer or a solver, or a market maker? And this is informed by like my market making kind of background here. So we introduce a third party, and their job is to front the user the money on the destination chain with their own capital. So they're going to make a short-term loan to the user, and they're going to do that within 2 seconds. And they're going to take on the risk of reorgs or weird things happening, for a small fee, and then they're going to get paid back after the protocol, quote unquote, like verifies that the fill happened. And that is what the intent-based architecture does. So a user wants to move from A to B. Let's just say they want to move one ETH from A to B. They send it into basically an escrow contract on chain A. These solvers see that and they go and they compete to fill the user on chain B in 2 seconds, very quickly. Sometimes we have like less than 1 second fills. They solve the user very quickly with their own money. They take on reorg risk, they take on finality risk, but the user gets a fast fill, and then the protocol later verifies the fill was valid before releasing user funds back to the solver.
In a sense, you're creating a almost like a cross-chain nostro vostro situation where you have a funding on one side and a risk on the other, and there are obviously funding risks or counterparty risks, and you have the actual infrastructure risk there to manage. But the experience is reduced in time to the point where the user doesn't see that happening. Now, maybe more of a lower level question, if you allow me. What is the what is the premium for that speed that users are willing to pay? Because I'm moving one ETH, there are gas fees in the entire chain of events, and there are risk premiums that that money needs to cater to, because the protocol won't pay for it, the users will have to pay for it. And speed is important to an extent that it's affordable to the user trying to do that, to perform that kind of jobs to be done. So is there a is I mean, you're operating on one end, you're operating an oracle, so there's a lot of data there. So is there any fluctuation? Do you follow? Is there an algorithm that predicts and allows people to decide what's the UX when it comes to a user facing the intent, and how do they make a decision?
So generally speaking, we're using market forces here to set these to estimate all these fees. And I kind of love this. Like it's like, hey, Maurizio, your question's very, very good. You're like, wait, there's all these kind of like risks here. How do you know what the fee should be? And it's like, well, we're just going to let people compete. Is basically what we end up doing. Um, to go deeper and to double click, like, okay, what are the costs? So user needs to send the gas, like gas fee to send it into the escrow contract. We actually make that really lightweight. It's fun if you go back and think about what is the cheapest possible gas cost for sending one ETH between Arbitrum and Base. It would be like one send on the origin chain and then one send on the destination chain. And our goal in gas costs is to make it as close to that as possible while still providing escrow and verification services. So we get those pretty low and actually feel pretty good about that. The other costs there are then, okay, there's the time value of money where the solver is making a loan and they're not going to get paid back immediately. How much is that? And it depends how quickly we pay them back, right? Which is like less than an hour-ish. Um, but there's costs around that. And then there's also this other edge case of a reorg risk. Like if the solver is taking on this like more sophisticated reorg risk, what should that be? And that gets quite interesting and quite complicated because it's on a per chain basis, how often reorgs are on chain, da 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 da. Um, but end of the day, we kind of lump this all together and we use the market to determine what these costs are, and they're pretty low. They're like a basis point or two for most of these trades. Which, if you think about a basis point or two, so we're talking about pennies or fractions of a penny on most transactions. Um, what we've seen and what our data supports with across is to get the 2 second experience, people are happy to pay a basis point or two in these costs. So yeah.
Interesting. I'm taking a look at my notes here, and I recall covering a in it seemed like an industry wide rally around ERC 7683, which is the cross chain Tanton Ethereum. Are you guys involved? What's like working in that particular environment?
We wrote it. We co-authored that standard with Uniswap here, and It's maybe a little bit technical, but the concept is we want as many solvers as possible because more competition equals better fills for users. Um, and it's as simple as that. And so we're like, okay, this intent thing is useful. We want there to be a standard around what an intent looks like here so that different protocols can write intents and they all use the same solver network. That was like the original impetus for the 7683 standard. And Uniswap very much like agreed with this too. So we're like, okay, cool. Let's define a standard. Let's make it an Ethereum standard of what the shape of an intent looks like, so that um, solvers can get more order flow, more people can build around this, and that was like very well received and continues to be.
Yeah, I remember that popped up. It was really eye catching, exactly because of the characteristics you described. And the maybe the most interesting thing, at least on my perspective, because there are risks being taken, you can add an additional layer of potentially risk arbitrage on top of those risks because it's just market, or insurance, which is another type of contention. And it rounds out, and you don't have to build it yourself. Somebody else that is on chain looking into the data can come up with a model that says, maybe it makes sense if we offset. Maybe because the risks are so low and the price points or the tickets are not as big, but as cross chain everything becomes more prevalent, well, then you have a market there that can absolutely and the reason why I'm going through this is because I've been poking around trying to find who's monitoring um, restaking risk, because as you mentioned, um, in your opening, that you were around during the global financial crisis. I was
Hmm.
around in the global financial crisis as well, and restaking to me feels very much like a CDS CDO type scenario, because you're
Yeah,
wrapping one thing into the other and this thing is moving around, and who the hell knows when this is going to unwrap for some weird reason nobody predicted. And I don't see anyone discussing. I've read papers like minimizing the risk of restaking. It's not that big. There's a lot of securities, a lot of liquidity, but we don't know. I don't think people are really stressing those scenarios out. And it will be very detrimental to the industry if we repeat the same mistake that actually generated the industry we're trying to build. And to me, that would be like, oh my god, really? Did we really do that?
yeah,
So that has been a consistent concern for me in the podcast. And there are other concerns in real life, but in the podcast.
yeah. Like a 2-second aside, I was young, but I was on the trading desk at Goldman, like in the heart of the financial crisis, and I was trading treasuries. The swaps desk was beside us. Our swaps desk, the Goldman swaps desk, was a big swaps desk. They did a lot of business, a lot of trades. We did a lot of trades with Lehman, a lot of trades with Bear too. Um, and in the depth of the financial crisis, Goldman, they had no idea what the risk was because there was all these contracts, but they just didn't know what was on the other side of them, right? The one thing that I'd say I think is hopeful, is, like, blockchain and some traceability and some transparency into what's where does seem like a big advantage here. But Maurizio, I hear your same concerns, and it's still early days here too. We want transparency is everything. So,
The little thing I started asking this year for the guests is about their health. I'm getting older faster every day, it seems. So I'm trying to just take better care of myself. Do you have any routine, any habits you've developed over the years to maintain health or be healthy in an industry that just doesn't sleep?
yeah, I do sleep. I think I've gotten better as I've gotten older about sleeping properly. And I do pretty standard stuff. It's like try to not eat like shit, try to eat well. Recently, I'm trying to drink less. That's a whole other thing. All the Gen Z kids that don't drink anymore, I respect them. But yeah, that would be a good thing. And I exercise. I like exercising, so I'm trying to get outside, standard stuff, and bookend my day. I don't work 24/7 because it's not sustainable. Um, so
That's good practice.
yeah.
Absolutely good practice. Um, in terms of industry, I mean, you've been around for a while. You built outside and inside the industry. You're offering alternatives to people who are building in the industry. So you build for builders as well. As an industry, what do you think is the one thing that if we don't fix it now, will continue to work in the industry for another decade or so or more, and we'll end up realizing that we didn't advance the industry because we just didn't fix that one thing? What's that one thing and why?
Oh man, spicy take time. Um, I I do think that there are like I am something of a decentralization purist here too. Um, where I do think that centralization risks will like bite Ethereum in the ass and crypto generally if they're not taken care of. And it's sort of like, what's the point of this whole technology that's trying to be like this decentralized blockchain if there are just single points of failure here? Um, and I do think oracles are a big source of that. And I mean oracles in a generalized way. So if we're getting price data, if we are getting cross-chain data, like cross-chain messages, any of this other kind of stuff, I think these are sources of real risk. And I think we can't ignore them. Um, Personally, something that I've been making a play to is actually on Ethereum we need to have faster like, these seven-day bridges are very damaging to interoperability, and I think it becomes so damaging to Ethereum interoperability, it risks Ethereum, ceasing to be the de facto place for asset issuance. Um, so basically, if we don't solve interop at kind of like a core level, and I'm doing a part of that, but I'm not addressing the canonical bridges that are used to rebalance assets. That's something that the L2 teams and Ethereum itself has to work on. But if we don't solve interop, people are going to issue assets in other ways that have worse security assumptions that I think really hurt our industry. So my recent push is we need to fix these seven-day bridges. We need everything. If everything was a 1 hour canonical bridge, we'd be able to build trustless systems that make Ethereum the ultimate place for asset issuance. And I think that's something that if we don't do in 10 years' time, we'll look back and I'll be like, that's not so good.
That's interesting. And that's interesting also because the recent mood around layer twos specifically is that they are sometimes an order of magnitude more centralized than Ethereum itself is. And they also have, because the tokenomics of Ethereum is what it is, it also has cannibalized protocol fees on Ethereum. And that's, I'm not a capital markets analyst, but the markets analysts in crypto attribute a portion of Ethereum moving sideways for so long, again, not financial advice, of, one of the causes is the cannibalism or the cannibalization, orchestrated by the sheer nature of the tokenomics and how layer twos operate. But you have a point. It may not be because of the price of the asset, but it may be because you're hanging less secure than things could be on what was once the promise of the world's decentralized settlement layer.
Yeah.
And that is not a story you might want to sustain for a very long time, because security is also sometimes opposite, sometimes part of the user experience. And you know as an industry, we should start from a higher ground, I'd say.
Yep. And I really like that part of it. Like Ethereum as the world's like global settlement layer. To me, that's a very compelling. It's not necessarily everything Ethereum is, but I think it's a very core part of it. And if you have a bunch of L2s that are like weirdly disconnected or like hard to interop with, it really hurts that value proposition. And I think this is something that I really think, and I think the Ethereum Foundation is actually focused on it now more too, but we got to move faster because we want this to be the place that any of the TradFi people, they're like, okay, I got to issue my stock, da 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 da. They want to be like, okay, I issue it on Ethereum mainnet, and it can go anywhere that Ethereum touches with amazing security for cheap.
Yep.
Right?
I mean, if we're in the middle of the so-called stablecoin summer, if money
Hmm.
can't flow in velocity of money is one of the components of a global GDP. If blockchains can't allow that to happen, then the contribution of blockchains to the global GDP
Yep.
will be smaller, even though there's a new form of money as a technology now available for multiple use cases. You're not seeing the actual results on real economy because it's still niche,
Yep.
because the interop isn't solved.
And the way Across's role in this, like, we're super stoked that, like, the Ethereum Foundation is pushing something following our standard, the 7683 standard that we wrote with Uniswap. They're pushing another effort called the Open Intent Framework that we are very much involved with too. That's trying to push intents to solve some of these interop problems all over the place. And like, it's super bullish for Across because it's just like more intents everywhere. It's great for us, and I'm really excited to be pushing that to solve some of these problems. But there's still like intense is like this fast layer of speed on top of the underlying canonical bridges. And so we still need those underlying canonical bridges. We need them to be better for intents to scale to get everywhere. And so this is the thing that I'm pushing on. If we solve that, then we're going to be able to have like BlackRock issue all of their ETFs on Ethereum mainnet and use intents to get them to all the chains in 2 seconds in modest size. And then if you want to do a huge size trade, you got to wait an hour or whatever. And like we got the whole thing covered. Um, but we just need a little bit more momentum around um, uh, the L2s themselves having faster connections to Ethereum mainnet so that the intent framework can go and deliver that last mile of super fast speed.
Would that also affect more than just asset transfers? Because um,
Yep.
I understand asset as a very provable, cryptographic, um, immutable representation of value. But data, blockchain is about the data. It's not just about the asset. So I can only imagine what type of particular experiences would be possible if you broach this into a more of a generic use case where assets one of the potential uh, transmissions, but you might have things that can be, because there is information asymmetry as well. I mean, you run an oracle, you know this better than I do, but even information might be a way for someone to fill that information gap on the receiving chain in a way that would be faster than like a messaging relay, for instance.
Yeah, I mean, the way to think about this, and all of this changes. This is with smart contract wallets everywhere, which is what this other standard called EIP 7702 enables. So we can now have smart contract wallets everywhere. But like, Maurizio, it's pretty interesting. If you want to execute a transaction on blockchain B, but your funds live on blockchain A, and you have no money on blockchain B, you can write a message for what you want to do on blockchain B, um, but you just need somebody to pay for it. That's the problem, right? It's like now the money I need to move is just my gas money in this new world. Um, and so if you think about that, intents are incredibly perfectly positioned to deliver this promise where, wait, okay, we get Maurizio to sign the message on what he wants to do on blockchain B. He just needs a little bit of gas money to pay for it. Oh, wait, in less than 2 seconds, we can move that message and the gas money to blockchain B and he can do his action. And if you think about that, now all the blockchains look and feel like one network that I just click buttons with funds on my home chain, and I'm doing all the stuff on all the destination chains really quickly and cheaply. The UX of how this all works, like how the wallets all do this, it's not all figured out yet, and I really want to be figured out ASAP. But like we have the building blocks to do this and to really make it like a far better user experience where a user just touches buttons and things happen on all chains.
Yeah, I mean, if you imagine this with the whole agentic internet that's coming, that's pretty much where you'd want to be, because you're mitigating a lot of that latency on the AI agent itself.
Yep.
We're approaching the end of our hour, so this went really fast, and thank you for making this really entertaining. Um, when you onboard new people, if you still onboard new people from your Goldman days, um, what's what do you give them? What do you tell them other than do your own research?
Look, if I'm gonna onboard like Goldman people, or like TradFi people from that, um, I mean, I still think my compelling pitch here is like financial rails, TradFi financial rails suck. They're like obviously broken. Um, and crypto is obviously better financial rails, which you're seeing people really really adopt in stablecoin summer. They're like, wait, stablecoins like stripes, like stablecoins are far and away the better way to move money around. These rails are better. And so the way I look at this is like there's so much noise in crypto, but if you're like, hey, we want to build a financial system that lets us do the some of the useful things we've always done in finance, but better, like cheaper, globally accessible, better ability to innovate. Like my bear case for crypto is we just reinvent all the financial rails. So I onboard people into thinking about it that way. It's a little bit boring. Like it's a little bit like, oh wait, we're not inventing, I don't know, something crazy out there. But we kind of are. We're like, hey, the financial system has been developed for a long time now. We've got a far better way of doing it that is global by default. Um, let's do that, and let's do that fast.
Love that. I mean, adjacencies and familiarity kind of breeds adoption, so it's only fair. Um, Before I let you go, how can people get in touch with you to learn more about UMA and Across and whereabouts in the world are going to be?
Yeah, I think follow. You can follow me on Twitter at Hal2001, HAL, which are my initials, HAL2001. And then follow Across Protocol and UMA Protocol. They're both at Across Protocol and at UMA Protocol on X too. Across is doing very innovative things, right? Well, both projects are, but Across is really pushing this intent framework, pushing interoperability. And I encourage users that want to go and like move assets between blockchains in 2 seconds, go to our website across.to, .to, like I'm bridging across to the next chain. Um, go and try the product out. We really get like glowing reviews around how fast and easy it is, and we want feedback.
Awesome.
So
Hart, thank you so much, man. It was a pleasure having you on the show, and hopefully we'll meet in a crypto conference around the world somewhere.
I would love that. Thank you, Mauricio. Appreciate it.
Catch us online. We're on Instagram at BlockDropsPodcast, on Twitter at BlockDropsPod or 0x Mauricio. We're on Lens at blockdrops.lens. We have a newsletter on LinkedIn. Write to us at blockdropspodcast@gmail.com, and you can listen to the Block Drops podcast at Spotify, iColab, Faberbun Tech, and all of the other major streaming platforms. Yay! Shout out to Hart for such an incredible insight on the aspects of blockchain interoperability, and also to Martina from Serotonin for coordinating this interview. And don't forget to leave the ratings on your favorite player and check out the merch store at blockdropspodcast.xyz. This is all for today. Stay rare, stay weird. LFJ.